Hi, Dan Ventura, Fairway Mortgage. Today we're going to cover the following topic. Fixed rates increasing, adjustable rate mortgages are becoming more and more common. I wanted to provide some information on what that means. There are two parts that make up an ARM. ARM stands for adjustable rate mortgage. It's the margin, which is a fixed component, and an index, which is the variable. By adding these two together, you come up with your rate for your adjustable rate mortgage. Again, the margin is a fixed component and the index is variable. Most common indexes that are used right now are CMT, which stands for the constant maturity treasury, and then the SOFR, which is the secured overnight funds rate. And to find these, you could just simply Google or go to Bankrate, and it'll show you what the indexes are currently trading at. So the 1-year CMT constant maturity treasury is currently 206. A month ago it was 189. A year ago, look at that, it was down 0.06. So it's gone up quite a bit in the past year. Secured overnight financing rate is very low and very stable. It's not as volatile as some of the other indexes that there are. So what you would commonly do is when you get an adjustable rate mortgage, you again come up with something that is a margin and index for the rate. So we're going to just walk through some common terms and what this means. So you'll see things like 7-1 or 10-1 ARM. Okay, so what this means is that the first number is the amount of fixed years that you have with the adjustable rate. So on a 7-1 ARM, you would get a rate of rate protection for 7 years. At the end of the 7th years, the loan will adjust one time per year. The 10-1 ARM, it's fixed for 10 years and then it'll adjust one time annually from there. And again, we're talking about the margin, which is the fixed component of the loan, and an index, which is variable. And another term that you'll hear quite a bit is the floor rate. What this is the lowest the rate can go. And that typically equates to what your starting rate is. So if your starting rate is 5% on an adjustable, the floor on that is going to be 5%. Caps is a little bit tricky, but the explanation is when you see three numbers, the three numbers break down as follows. The first number stands for the amount of your first adjustment once the fixed period ends. So in a case of 5% caps, 5% being the first number, your rate at the first adjustment can go up 5 percentage points at that time, okay? So it's important when you get the adjustable rate mortgage to keep an eye on the indexes as you get closer to the expiration date of that loan. The middle number here represents the amount each subsequent adjustment can be. So it would be 2 equals 2%. So let's just say, for example, we have our start rate of 5%. In 7 years, rate goes up. We know it can't exceed 10%. Giant jump, yes, but it's just something that you need to understand all of the risks that are associated with them. Each subsequent adjustment from there can only be 2 points, okay? So we can't exceed 10% ever because that's built into the third number here. That's the max number that the rate can increase over the life of the loan. So the initial and the max are one and the same. So what happens if things go down from here? You can, at the end of your first year of an adjustable, it can go down 2% to 8%, but it can never go higher than the initial cap rate of 5% over your starting point, okay? So why would people go with an adjustable rate mortgage? The main thing is that 7 years and 10 years is a very, very long time in the life of a mortgage. A lot of life happens, and the adjustable rate mortgages come with lower rates than the fixed mortgages are right now. So you can get into a situation if you think it's going to be a starter home, a home you're not 100% sure, it's not your forever and ever home. Take a look at an ARM and what the savings can do for you over the life of the loan. If you have a low rate or lower rate and you're in a 7 and 10-1 ARM, the amount of extra principal that will be paid down due to you having a low rate will be dramatic. And it's a great way to get into a house at a lower payment with the understanding that, this isn't your forever home and that you really want to do something by the time these loans expire. You could always refinance at any time. There's never any penalties. If fixed rates drop down, you could always refinance into that. Or you hold on to it and the margins and indexes float lower, and then you end up keeping the rate for quite a while. I will tell you that in the past, whenever I have gotten a mortgage, it's always been an adjustable rate, because I believe in the power of having a lower payment and a lower rate initially right out of the gate, because like I said, there's a lot of life that happens in 7 and 10 years, and the likelihood of you holding on to a 30-year fixed for that term is very, very, very slim if that would ever happen. So anyway, this is how adjustable rate mortgages work, and I hope this was helpful.